Greetings, everyone. Welcome to the second module on Introduction to Swap Contracts. In the first module, we covered the basics of the swap contracts, the confirmations, and the currency swaps. In this particular module, we are going to focus on interest rate swap. So let's start. So the most common type of interest rate swap is a fixed versus floating swap, in which one party pays fixed interest rate and another party pays variable or floating interest rate. This floating interest rate is reset periodically according to the benchmark being decided between the two parties. And most of these contracts on floating rate are based on LIBOR. In interest rate swap, the notional is never exchanged. I mentioned this in module 1 as well. So we take a certain amount, let's call it $100 million. One party is going to pay a fixed interest rate, let's say 5% on $100 million to party B. And this party is going to pay a floating interest rate, let's say LIBOR plus 50 basis point. On the same notional, B is going to pay this interest rate to party A. Basis point, BPS, 100 basis point is equal to 1%. So this is your interest rate swap. So notional is never exchanged. One party agrees to pay a fixed interest rate. This is also known as swap rate. So fixed rate on a swap is also known in the market as swap rate. The other party agrees to make a return payment on regular future dates based on variable interest rate. So this will be reset periodically. This is going to remain fixed for the entire tenure of the contract. When a floating payment is made, the rate is reset to establish the next floating payment in the sequence based on the benchmark being selected by these parties. So question, which leg in the swap transaction is called a swap rate? Fixed rate leg. Now let's talk about the comparative advantage argument. Consider the use of IRS to transform a liability. So we are assuming here that there are two parties, they have certain liabilities and they want to change the nature of their liabilities. Okay. So some companies, it is argued, have a comparative advantage when they are borrowing in the fixed rate market. And it is very much possible that other party has a comparative advantage when they are borrowing in the floating rate market. Don't worry about this term. Once I give you the example, this term will be pretty clear to everyone. So to obtain a new loan, it makes sense for a company to go into the market where it has a comparative advantage. So as a result, the company may end up borrowing, let's say on a fixed rate basis, just because they have a comparative advantage in that particular market, even though they wanted to borrow on a floating rate market, right? So let's take an example. Let's say there is a company Alpha. This is a top rated multinational and they can raise fixed rate funding through a bond. 5 years bond they can issue at 10% coupon. So they will keep on paying 10% for 5 years. But actually Alpha company wants to raise money through floating rate bonds. So it could borrow money on a floating rate as well. In this case, they would have to pay LIBOR plus 50 basis point. Consider second company, Beta, who also wants to borrow for 5 years, but they want to borrow in the fixed rate basis, on a fixed rate basis, right? Let's say they can borrow at 10.5. Unfortunately, their investment bank have told them that the market has no appetite for their fixed rate bond. So they are left with no choice but to borrow money in a floating rate market by paying LIBOR plus 75 basis point. Just remember these parameters. 10% LIBOR plus 50 for alpha, 10.5 LIBOR plus 75 for beta. Actually, this is a no-go because there is no appetite in the market. So step one, identify the parameters of the deal. We already have identified alpha could borrow at 10% in the fixed rate market, or they could borrow at LIBOR plus 50 basis point in a floating rate market. Beta, though they want fixed rate, they cannot get it, so they have to borrow at LIBOR plus 75. So these are your parameters. Alpha, 10% in fixed rate, LIBOR plus 50 in floating. Beta, 10.5 in fixed rate, and LIBOR plus 75 in floating. Now the second step is identify the market in which alpha has the most advantage. If we see here in the fixed rate market, alpha has an advantage of 0.5% above beta. This is what I meant by comparative advantage, right? And in the floating rate market also, they have advantage over beta because they have to pay 0.25% less compared to what beta has to pay. So they have advantage in both the markets. So alpha has an absolute advantage in both the markets, but they have relative advantage in the fixed rate market. So if we look in the fixed rate market, they have to pay far lower than beta when compared to the floating rate market. So a rule of IRS is that interest rate swap is only possible when there is an absolute or a relative advantage. Alpha has absolute in both, but relative in fixed rate market. So alpha will access the market in which it has the greatest cost advantage. Now let me go back. Remember, alpha want to borrow on floating rate basis, but they have relative advantage on a fixed rate in a fixed rate market. So it makes more sense for alpha to borrow in a fixed rate market. Beta has no choice because the only market available for them is floating rate loan market. So now, second step is we have to work out the difference in the absolute cost advantage between the two markets. Alpha has 0.5 advantage in fixed, 0.25 in floating. The difference between the two is 0.25 percentage. Now these parties will be interested into entering into a contract only if they get some benefit out of it, right? Plus bank will be the middleman, so bank also needs the benefit. So this 0.25 we need to divide between these three parties. So everyone gets a benefit. So now have a look here. Alpha is borrowing at fixed. Beta is borrowing it at floating. But what beta wants? Beta wants to pay fixed and they want to pay lower than 10.5%. Whereas alpha, they want to pay floating, but they want to pay lower than LIBOR plus 50 basis point. Okay. So now let's have a look that how a bank can arrange this IRS. So alpha borrows at fixed, beta borrows at floating, and then bank will allocate this 25 basis point comparative advantage among the three parties. Okay, how bank is going to do that? Let's directly look at the graph. Beta will pass on 10 percentage to the bank. Bank is going to pass on 10 percentage to alpha. Alpha is going to pass on 10 percentage to their investors, right? So till now, beta is paying 10, alpha is paying 0 till now. Okay. Now alpha will transfer LIBOR plus 35 to the bank. Bank will charge 5 basis point as their commission. So from this, they will take 5 basis point and remaining, they are going to transfer it to beta. Now beta, with this, they are going to add 0.45 basis point, not 0.45, 45 basis point, that is 0.45 percentage, and they are going to pay this to their investors. All right. So ultimately, alpha has received 10% from beta, and they have paid 10% to the investors. So this 10% is out. And to the bank, they have transferred LIBOR plus 35, correct? So their net cost is LIBOR plus 35. In the initial stage, what was their net cost? LIBOR plus 50 basis point. That means an advantage of 15 basis point for alpha. At the same time, they are now happy because they are paying floating, which they actually wanted to pay. Let's look at beta now. Beta received LIBOR plus 30 from alpha, from the bank rather, right? Right, LIBOR plus 30. And beta paid 10%, right? And LIBOR plus 75 to the investors, correct? So this LIBOR plus 30 and this one, LIBOR plus 75, what is the difference? 0.45. and this 10%. So 10% plus 0.45, ultimately beta is paying 10.45 fixed, which is what they wanted. They wanted to pay fixed and they wanted to pay lower than 10.5 percentage, and they received the benefit of 5 basis point. At the same time, bank also made a profit of 5 basis point. So this is how you have allocated this 25 basis point comparative advantage among three parties by the use of IRS. So in summary, the most common type of interest rate swap is fixed versus floating, though we have floating versus floating as well, just the benchmarks are different. The notional is never exchanged, it is only used to calculate the payments. Fixed rate leg in a swap transaction is also known as swap rate. And the rule of the IRS say that IRS is only possible whenever there is absolute or relative advantage in any one market for the parties. So this is the end of this training. I hope you enjoyed this training and I hope to see you in our future trainings as well.